2025 has been a good year for investors, with most major asset classes finishing in positive territory. But investing, as we know, is a forward-looking game, and that's what Livewire's Outlook series is all about. Joining me to talk about the outlook across major equity markets and some of the key events you need to watch in 2026 is CommSec's market analyst, Daghlian. We'll also be taking a data snapshot to see how thousands of Australian investors are positioning for the year ahead. Stephen, thanks for coming to Livewire, and great to catch up again.
Thanks for having me, Jimmy. It's been a long time.
So, Stephen, what is the outlook for major equity markets in 2026?
I think I've got to be honest from the outset. I think with all predictions, we've got to take it with this gigantic grain of salt because so much changes over the course of the year. And I think 2025 served as a pretty stark reminder of that being the case. But it still is useful, right? And also enjoyable to come up with these predictions. As far as what we've seen in historically, I think that's probably a good place to start because going back 20 to 30 years, the S&P 500 has had total returns of about 10 to 11%. The Aussie market hasn't done quite as well. We've got the ASX 200 here giving back around 8 to 9% on an annual basis. Also, what's important is that the S&P 500 has had these outsized gains for 3 years, which is way above those averages as well. So 2023, 2024, roughly 25% gains over both of those years. And then over the course of 2025, at the time of recording at least, we've had gains that are decent as well, well above that too. Projections though, over 20 strategists were surveyed on this, and the base case is to see the S&P 500 ending 2026 at about 7,500 points. So that would represent a gain of about 10% for the S&P 500. But right at the most optimistic end, they've got 8,000 points as a target, and that would be a gain of about 18%.
What we have seen though, you talked about the long-term divergence in returns between the Aussie and the US market. That's played out this year. US market, S&P 500 up 16 or so percent, time of recording. Aussie market, mid-single digits. Do you expect that divergence to continue?
It's always very difficult to tell. I think it's going to hinge on a few things. For the US, how aggressive the Fed is going to be with interest rate cuts over the course of 2026. Also, the market's love affair with AI, is that going to continue or are there going to be issues over the course of the year? Also, are earnings going to continue to grow because of valuations already being quite stretched, both for the American markets, for tech stocks, and also for the broad Aussie market as well. And I think for us here in Australia, it always comes down to really how the materials do and how the financials do, because combined, they're massive. About
big part of the index.
55% of the index really comes down to those two sectors.
Let's talk about some of the events people need to put in their calendar. There's always a couple of big ones that we can focus on. What do you think are the major events people should be looking out for in 2026?
That's right. Look, central banks, I think, probably going to be in the spotlight. You've got AI again, which will be in the spotlight as well. Tariffs, and I think US midterm elections, which is kind of at the margins, but it could just keep markets on edge towards the end of 2026. So if we start with the central banks first up, most of the world seems either done with interest rate cuts or pretty close to it. I think the US is kind of an outlier there. At the time of recording, which is ahead of that December decision for the Federal Reserve, the market is pricing in a couple of rate cuts over the course of 2026. Having said that, stickier inflation is going to be a risk there because the Fed's preferred measure of inflation already is a bit too high, up close to 3%, and the Fed would much rather see that closer to that 2% mark as well. So that is going to be a risk. Then you've got Jerome Powell's term ending in May. So that's going to come pretty quickly. And there's an expectation there could be a Trump-friendly, dovish candidate that is put in place there. But, we'll have to wait and see because they've gone from 10 candidates being on the shortlist to 5, and now it seems that Kevin Hassett is the favourite. That could easily change as we go into the early part of the year. But he's considered to be dovish. It could mean more interest rate cuts. So there's still a bit up in the air as far as how that is actually going to play out. Yeah. Here in Australia, with the Reserve Bank, I think they've made it very clear in December that pretty much no more rate cuts, which is obviously sad.
It's not really the Santa gift we were after.
Santa's not visiting. I think if you've got a home loan, as far as what the Reserve Bank has been signalling anyway. So the RBA governor's made it pretty clear, I think, and she was quite hawkish at a media conference saying that not only does she doesn't think that there are any more rate cuts on the horizon, but now she's put it down to two things. I'm quoting her that basically, paraphrasing, is it going to be an extended hold? Or is there a possibility of a rate rise? So she's clearly opened the door, probably more than what some had expected after that actual statement was handed down. She was much more hawkish in her commentary. It's not really surprising though, Jimmy, because we've had hot inflation, September quarter, and also for October as well. Household spending's robust. Economic growth is decent. The labour market has also been quite resilient as well. So that next interest rate decision is going to be interesting because that's going to be right at the start of February the 3rd. Just before that, you've got quarterly inflation that will be handed down. And that is, I think, going to be critical. If that comes in hot, then that certainly is going to, potentially lead to a rate hike at some stage by the RBA.
Yep.
Moving to AI, I think that's going to be massive as well. It's a key theme. We've heard about it a lot already, but it's partly because of how top-heavy the American market really is. I mean, NVIDIA a couple of months ago, $5 trillion market cap. That's about twice the size of the entire Aussie market, which is ridiculous to even say. But the top 10 largest stocks in the US account for about 35 to 40% of the S&P 500, and that weighting is way higher than it was, say, a decade ago. So that always is a risk as well. So I think the questions that are going to be asked for AI specifically is around that massive spending commitments, because many of these stocks, companies like Microsoft and Amazon and Meta, they've committed about $100 billion each on AI infrastructure. And Google's CEO recently said that AI infrastructure spending in the next couple of years is kind of going to be as much or more than the last 10 to 20. So it's massive. So those earnings results that we get coming through on a quarterly basis in the US are going to be so important. And the first of that's going to be, in a couple of weeks into Jan, you're back from holidays, and then you get earnings results to enjoy for everyone.
Hold your breath moments, the big mega cap tech stocks at the moment, aren't they?
And it's not going to take, if they disappoint the market, then it could be a bit of a rough start to the year potentially for some of these big names as well. Tariffs. Should touch on tariffs as well.
They've sort of moved off the front page.
They have. That's the thing, right? Like over the course of 2025, we started off the year at pretty close to record highs. In Feb, we did hit record highs. Then Liberation Day happened. We saw markets going into bear market territory. And then I think when markets started to see it, the worst case scenario probably not playing out, that seemed to kind of have markets feeling a bit more encouraged about it. Still, there's the uncertainty of tariffs. There's that US-China trade truce. Is that going to hold? Is that, fragile? Could that go pear-shaped? That's a possibility, and I think that is still going to be a risk. And finally, the US midterm elections. Early November, it's when voters in the US go to the polls. It could create a bit of volatility and uncertainty in markets, but typically, once it's out of the way, markets tend to do quite well for a 12-month period as a bit more certainty enters markets.
Okay, some good points there. Definitely some of the big themes that have dominated 25 look like they're going to push into 26 as well. But let's bring it back to the Aussie market, which is obviously a focal point for a lot of our viewers and I'm sure CommSec investors as well. Banks and miners, big on the ASX. You talked about how important they're going to be. Have you got a few ideas and any other sectors, or a few comments you want to make on the banks and the miners, and then any other sectors you want to put a spotlight on?
Yeah, absolutely. I mean, we should start with the miners because they've hit record highs in December. They're 25% higher over the year, roughly at the time of recording, at least best year since 2016. Commodity prices have been making a comeback. The US dollar's been weak. I think all of these things have helped. Is that going to lead to similar gains over the course of the year? That remains to be seen, but it could certainly be helpful, at least for earnings and for potentially capital returns and dividends as well. Gold, has doubled as far as what we've seen the gold subsector do on the Aussie market, while gold prices have jumped to 50, 60% over the year. So I think that's a reminder, even when you get reasonably strong or very strong improvements in commodity prices, that can actually lead to even bigger improvements in margins and profits as well. So that's gold. And if there are more geopolitical issues and concerns going on, then that could be supportive for the precious metal. Lithium, there's been certainly an improvement coming through from June for some of the big lithium players, and there have been more calls out there saying that there could be a deficit sooner than expected perhaps. Copper hit record highs, 30% higher. Silver doubled, it hit record highs as well. All of these things have been helpful, and that could, sets things up quite nicely for them. Iron ore, a little different, not doing quite as well, but it's
But probably not as bad as feared.
exactly. So I think that's a very good point because yes, we've only had some small gains, but we've got iron ore at $105, $110 in recent times, and that's higher, I think, than what many were expecting. So that could at least be supportive for some of these iron ore plays, and that's partly going to come down to China. I mean, China buys 70 to 75% of the world's iron ore. They might set a target of 4.5% to 5%. That's what's expected, and any spending plans or support plans coming through from the Chinese government will be important. But their property market is not doing so well, and it's probably not going to change anytime soon. So that's a little bit of a weight there. Yep. The banks that you point out, I mean, they haven't done particularly well. They've underperformed a bit, at least times during 2025, especially in November when they had a bit of a shocker. They kind of fell off a cliff for a short period of time. Valuations were kind of stretched, so it's kind of understandable, I guess, that they were sold off a little. The pause in rate cuts might be interesting. It could help margins because there was not too long ago an expectation there'd be more rate cuts, which can generally be a negative for margins. But if there are rate hikes, what could this mean for potentially slowing down the property market a little? So that potentially could be a little bit of a negative. But as usual, you have to wait a bit to get all the earnings from the banks. So we've got to wait till May for most of their half-year results. Consumer-facing stocks, again, interest rates I think will be important here because if rates are even just discussed as being a possibility of rising, is that going to be a negative for consumer spending? Are people going to be more cautious going to the shops and spending money? And could that be a negative for their profits or their share prices? And when it comes to tech and healthcare, the two worst performers in 2025, that has partly been because of just a bunch of those really big names that have done quite poorly. The WiseTechs, governance issues, it's struggled. CSL obviously has been a massive one, which
big drag on that sector.
Massive drag on the healthcare sector. So are they going to try and reassure markets, try and be a bit clearer with their plans and their earnings, and that could be potentially supportive.
Good to get some views across the sectors there. What I thought would be interesting was just to have a look at how investors are positioning. CommSec's Australia's largest online broker. I've asked you to put together a few little data snapshots for us, just to give us a sense of how people are positioning. First point, which shares or ETFs have been most added to CommSec clients' watch lists in Q4 of 2025? It
is an interesting one, isn't it? Seeing how people are positioned for the coming year. And there've been stocks that have kind of aggressively been moving in either direction, either higher or lower, or there's been some big news that has just had them in the media. So Drone Shield has been right at the top of the list as far as added to watch lists, which is not surprising, I guess. It's been on a tear, was on a tear for a lot of 2025, hit record highs, was up like 700 or something percent at one point, and then it fell about 75% from October to November, partly because of some of the leaders selling off their stock. So that was up there. Pilbara was another that was right up there, and I think the recovery in lithium prices has been one reason for that. CSL also made that list, and I guess a lot of people know CSL. It's the largest stock in the healthcare sector as well. It's been a consistent performer, at least in the past, but it kind of hasn't gone anywhere for quite some time. And then more recently, it's fallen quite heavily. So it also made that list.
Yeah. If we look more broadly, which shares and ETFs are the most widely owned? So not added to watch list, but the most widely owned across portfolios.
Yeah, these are kind of usual big names. They don't change that much. The order changes around a little, but you've got the big five banks make that list. You've got BHP and Woodside. They represent, I guess, the resource sector as a whole. You've got Wesfarmers representing the consumer-facing stocks. So it's also made that list. Telstra, for the yield, it's on that list as well. And then you've got CSL. I was mentioned this a few times, but it also has made that list, dropping down a few spots, but it still is there.
Yep. And the ETFs?
The ETFs are kind of like the NDQs, the VASs, the IVVs. They're all on there, and they're quite consistently been on there for quite some time.
Yeah, very good. Thanks for bringing along that data.
No worries.
Listen, if we're sitting here in 12 months' time, what are one or two things that you think investors will have needed to get right to have had a good year in markets?
Just be patient, not get too caught up in the headlines, because it's very easy to do. I think it's hard to guarantee anything in markets, but if there's probably one guarantee is that there's going to be headlines that move markets around in one direction or another at some stage in 2026. So I think keeping a cool head when that happens, and just knowing that knowing that they're going to come up at some stage. 2025 was a really good reminder of that, I think. Yeah, as I mentioned earlier, record highs in Feb, went into bear market territory for the S&P 500. We had a 7.5% fall in about 2 to 3 days for not only the S&P 500, but for the ASX 200 in April around Liberation Day. For those that held on, you've had the Aussie market rally by 30% from that low through to record highs in October. The S&P 500 rose 40% over that period, and then tech-heavy NASDAQ rose by 60% over that period. So it kind of just shows that these things happen, and if you keep the course and have a long-term view, hopefully you do okay.
Great. Well, Stephen, it's been great to catch up after all these years. Really appreciate you taking some time to give us some thoughts on what lies ahead in 2026. And as I said, hopefully we be able to catch up in 12 months' time and see how some of the ideas played out.
Thanks, and Happy New Year.
Happy New Year to you too. Ladies and gentlemen, I hope you enjoyed that interview with Stephen Daghlian, market analyst at CommSec. It's part of LiveWire's Outlook series. I'd like to thank CommSec for their support with the series again this year. Remember, check out our YouTube channel. We've got a bunch of great content dropping throughout December and January.